Good morning, audience. Welcome to the Sense of Things. It's Jeff and Ron here again for another episode of the Sense of Things podcast. And on today's show, Ron's going to take the reins a little bit and talk to us a little bit about, he's got some trivia for us. He'll be talking about the Atlanta Fed's recent update, which is actually interesting because although we laughed at them last year, they were actually pretty accurate in their estimates. So we'll see if they're accurate this time as well. In addition to that, Ron's going to talk a little bit about an update for the sectors for this year. So stay tuned. We'll be right back in just 1 second. Welcome, folks. Welcome to the Sense of Things. And Ron, how are you, my friend?
Good morning, Jeff. All good. Never a dull moment as usual between the State of the Union, economic news, geopolitical fears, all that good fun stuff. The markets are getting thrown around like a rag doll.
Yep. Yeah, it's funny. The model that I use leaned into adjusting to be more conservative this month. And my clients are all like, "Oh, you're a genius." And I'm like, yeah, sometimes you're right. Sometimes you're wrong.
Got to tell you, there's a saying that I hear every now and then, and every time I hear it, I'm like, God, I got to use it more often. And I think it applies today because I had a couple clients that were freaking out after the State of the Union.
Yeah.
Got to calm them down, say, hey, look, the sun's still going to rise tomorrow, all that good stuff. But I thought the saying of the following is, it's not about timing the market, it's about time in the market.
Yep.
And if you try and time these things based on headline news and rhetoric and all that other stuff, it's a fool's errand. So stay in high quality stuff because on the way down, you add to it because it's going to be spring coiled on the way up past non-quality stuff. So it's time in the market versus timing the market.
Yeah. Yeah, and it's not like we're going to cash, but in my case, we just pulled back a little bit of the higher beta stuff, the NVIDIA type stocks and Palantirs and things like that. Pared those back a little bit, and we've just got a little bit more higher quality dividend payers in the portfolio, and certainly pulled back a little bit of the exposure to the stock market because I just think it's just going to be a little crazy right now with all these negotiations going on between countries and tariffs and trying to get things cooled down in the Middle East and things cooled down in Ukraine and everything else. And it's just going to take some time to get through some of this. So it's sometimes just play it a little safe is not always a bad thing.
I agree. But you know what? If you read the headlines, you'll lose sleep.
Oh, yeah.
It's just what it comes down to.
I just ignore the news period at that point. And just
look, to freak out and lose sleep is insane.
Yeah.
To be worried, to be concerned, that's okay. But you can't let it affect your life.
No. And once again, it's going to change. And what we've seen is so much of the market now is run by what you would think would be rational, but so much of the market is run by bots and things like that. And they're responding to every news headline and causing all this gyration and all that. So either if you're invested for the long term, this is just going to be a short-term blip and a long-term thing. If you're invested for shorter term, or if you're in retirement, this is the time to maybe have a little bit less exposed to the stock market is the way I would look at it.
I agree. All right, let's turn it over to some trivia.
I love it.
All right. A snail can sleep for how many years?
Let's go 10 years.
All right, a little less.
Okay. 3 years.
I got to tell you, I better wake up refreshed if that's the case.
No kidding. I don't know how refreshed you can be as a snail because you wake up and then some Frenchman picks you up and cooks you. That just sucks.
I think atrophy would have set in by then too.
You'd think.
All right, number 2. How many heart chambers does a cockroach have?
I don't really want to know, but I'm going to say 4.
12.
12. Holy crap.
No, maybe that's why they can survive a nuclear blast.
Yeah. Yeah, you could kill half the heart.
I don't know. Yeah, they may lose 10 chambers in a nuclear blast, but they still got 2 that are going.
Still going. Yeah, they're still chugging along.
All right. And which animal never sleeps? I actually heard this many years ago and I forgot.
I'm going to say whale.
Bullfrog.
Bullfrogs never sleep.
Maybe that's why they're so puffy.
Yes, that's why they're so puffy. That's why they've got the eye bags on them all the time, everything else. And they're just trying to stay away from the Cajuns and the frog leg thing.
Yeah. All right. So that's the three trivia for the day. I have a whole slew of them in the upcoming week. I love trivia, so we'll be good. All right. So I think this is funny because last year we were laughing and scoffing because
Yep.
the Atlanta Fed always was out of range with consensus with the other Feds when it came to GDP, when it came to other economic numbers. And they
Yeah.
came out last week and basically said, nope, we're looking at negative GDP growth for Q1. And could they be right again? Now, obviously, a lot of people go by, oh, if you have two straight quarters of negative GDP growth, we're in a recession.
Yeah.
No, that's not the actual indicator. As we know, the indicator is by the NBER, the National Bureau of Economic Research. They dictate when we're in a recession. It's
Mm.
just that two straight quarters of negative of growth typically are a catalyst or a kicker for what may be to come.
Yeah.
What are your thoughts on this? Because we were laughing at them last year and they ended up being almost dead on.
That was and they were so different from everybody else. They were so far off, and they ended up being, I think, within a half a point or something
They were the
like that.
closest.
Yeah. And it was scary, and people laughed at them and, oh, they don't know what they're talking about. I honestly, knowing what was happening going into Q4, and you're still seeing inflation's coming back. The prices have not come back. Plus, you've seen some of the agricultural products still continue to go up. I don't honestly, I can follow along with them on this. I don't know if it's going to be as bad as what they say, but I think it could be pretty dang close. I could see it being in the negative.
But here's the crazy thing, Jeff. Look down below here. This is
Yeah.
reading it every 4 days,
Yeah.
and they're adjusting it. And they were positive since January. And then all of a sudden, I don't know what happened here last week that they said, nope, sorry, we're going to go from, let's say, 2.1 down to negative 2.8,
Yeah.
2.7. I didn't see what the catalyst was. It had to be tariffs.
Yeah, I was going to say that's the only thing I can think
spending.
is, yeah, they're trying to project forward what consumer behavior is going to be. That's the only thing. It's the only reason I could think that's where they would go that way, is just trying to project what's going to happen with tariffs, which I could buy into because there's just a lot of uncertainty right now, and people don't really understand how these tariffs are going to affect this stuff right out of the gate. And I think there's still a lot of negotiation going on. I know Trump's speaking to the Mexican president today. She's got a big announcement on the weekend. I think this is such a fluid situation right now that things could change on a heartbeat. And I think that's why you're seeing all this incredible volatility in the market.
Yeah, I agree. All right. So the next thing I thought, talking about not timing the market, but time in the market. And you got to love this. So this information is over 30 years old, 35 years old. And this is if you only owned the market or you're after the decline days versus after all the up days versus just hold your damn positions, the high quality positions. And I think this is interesting because we're seeing it today that after you get a big up day, typically there's a down day, right? It's like a dead cat bounce, it's a head fake, whatever you want to call it. And then after, a lot of people love to buy on down days, right? They're adding to quality positions at a discount, whether it's small, medium, or large, and you get bigger up. But if you just hold the quality positions, you're up over time. And I thought it was interesting that if you just look, if you hold it up over down days, I mean, you were basically flat for 35 years. At least if you bought or went back in after down days, you performed pretty good.
Yeah.
I know you're a buy and hold guy with most of your stuff. What are you telling clients?
You know what? The model that I use, it was a model that I developed over literally the past 7 years. I personally have tested it in my own portfolio for almost 5 before I used it with clients. And the biggest difference with the model is it just takes stuff off the table. We're never going to go to cash and then back in or try and buy in on specific days. It's a monthly trading model that I follow, and it follows momentum of where the markets are going. At times like this, it's going to pull some of the risk off the table. We're still invested, and we've
Yeah.
still got a significant investment in the stock market. It's just that we're going to pull back, and it will pull back on things that are much higher beta when the market's going like this. And you can't fight the market. If you look at if you look at the chart of the S&P for the last 6 months, it's rolled over. It rolled over almost a month ago, and it's been on pretty much a downtrend with a few of these little bounces up. Yeah, I just don't want to have as much exposure to the market when it's doing it, because you just can't win. It doesn't matter if you've got good or bad. It's just not going to do well, but you still need to be there because you don't know when it's going to turn.
I agree. And then my last slide here is just now this is a few days old. Obviously,
Yes.
like I said, the market keeps getting thrown around here.
Yep.
But one of the areas that I thought would be a good theme this
Mm.
year and last year was healthcare.
Healthcare. Yeah.
And so far, it's been one of, I don't know, I know it's going back and forth the last few days. Year to date, it's actually been one of the best performance. Now,
Mm.
rather ironically, financials got crushed 2 days ago,
Yep.
came back a little bit yesterday. I'm not a financial sector guy. And of
Mm.
course, the consumer staples, this should be interesting also to see how
Yeah.
the tariffs play out and how it's going to affect the consumer spending. But we shall see. And then I heard the last couple of days that a lot of the big real estate developers, specifically on the industrial and commercial side, are holding off on big projects because they don't know what the cost of the materials is going to
Yeah.
be.
Yep.
So they're trying to figure that out, or they're trying to hoard stuff that is tough for them to get in anticipation of what they may need to build. So
Mm.
obviously, that's another reason why our markets are the way they are, and probably will continue to be in the first half of this year,
Yeah.
because until things settle down, till the dust settles, till people really have a better grasp and handle of, forget about a year from now, but even the next 3 to 6 months, it's going to be tough for people to figure out what to do.
Yeah. And I think that plays right into the GDP argument we had at the beginning. I think the Atlanta Fed, it could actually work pretty close to that. It just could be on the money that everybody kind of pulling back because of the uncertainty. That just may pull back the market, period. And on the next show, I'm going to do some research, or I've done some research on kind of what's going on in the economy and the economics. And I think some of that's playing out. You're already starting to see a little bit of that.
Yeah. Yep. So until next week, more trivia, more news. Like I said, never a dull moment. There's
Yeah.
always going to be something, but I think it's going to be a little rocky here in the first
Yep.
half. I was talking about this in December and January, and I thought it was great. I heard this one market strategist say, buy the election, sell the inauguration.
Yeah.
And I can't remember who it was, but he was absolutely correct.
Right on the
We'll
money.
see how things shake out here, but this
Yeah.
is a great time to look for a lot of these high quality, high beta names, because when these things settle down, those things are going to be
Yeah.
spring coiled
I
to
got
the
a rocket
upside.
ship. Well, and I think one of the things that I've paid out really close attention to is looking at who's performing well with the market downdraft, like we've seen, who's performing well. And it doesn't mean that they're going up when the market's going down, but I've been looking at the ones that have really stayed up and have not followed the market down a little bit, and a lot of them are names that you're seeing more market breadth. A lot of them are names that you may or may not have even heard of before, but I think there's an opportunity, and I think we'll see much broader market breadth than the market being run by 7 stocks over, like we've seen over the last few years. So I think there's
I
a lot of
gotcha.
great companies out there that are on
But
sale
they
and
needed to come
great.
down. So they're
Yeah.
coming down to a more reasonable level. Are they
Yeah.
dirt cheap? No,
Nope.
but they're much more reasonable if you want to start nibbling or adding a
Yeah.
position. So
I
we'll see
totally
how
agree
things
with you.
shake out. But I think this is definitely a time to start putting some good money into good quality stuff.
I am right there with you. And these are always the times that I like having a little bit extra cash on the sidelines to be able to put into some of this stuff. We prepared for it. We've got a little bit bigger kind of safe positions to where we can put stuff back in, but got to get through some of the craziness first. All right, man. Good. Folks, make sure that you stay subscribed to the channel because we're popping these things out as fast as we can pop them out. And we will see you guys back here the very next time.